Hey everyone, this is Kirk here again at OptionAlpha.com, and welcome back to the video recap that we do here each and every night on the membership side of our blog. Today was actually a pretty good day. We had two opening and two closing orders. One of the opening orders that we had today was a hedge of our current Netflix calendar. So I'll cover that last because I want to cover it in a little bit more detail. It's actually one of the first of these that we've actually done this year with these calendars and kind of hedging it for the next move. So I want to cover that one in detail at the end of the video. But going over some of the closing trades today, we bought back the last two verticals that we had in our IWM credit spread. So if you remember, last week we had closed out of half of this position, and this week we're closing out of the other half of this position by buying back the two 108, 106 credit put spreads that we had originally sold for $50. So we bought those back for $25 today. Made a nice little $25 profit on those. So generally it was a profitable trade. I'd like to see obviously the IWM move higher, but now that we're getting closer to expiration, we've already made half of our potential max potential gains. So at that point, it kind of fits the criteria for closing out the trade. Same thing with BAC. So Bank of America has been one that has been a little bit different because the stock has jumped, but it's just kind of trading sideways. So we've actually seen a lot more of a move down in the time decay of these options than we have anything else, but the credit between the options actually hasn't moved too much. We're still kind of on the edge here, and again, with June expiration coming up so close, we felt it was best just to close out this credit put spread as well and bank some profit. So we went ahead and bought back our vertical Bank of America June 15-14 credit put spread for an 18-cent debit. So overall, we made about $15 per spread. So it was actually a fairly decent trade. We made a little bit of money, about half of the expected gain that we were trying to make out of Bank of America we kind of got here. So if you actually look at the chart of where Bank of America is right now, you can see the first thing that we noticed is implied volatility did drop below that 50th percentile. So we got the implied volatility move that we wanted, and we also got the pop in the stock that we wanted, but you can see that it's just kind of really been range bound right above 15. So what I'd hate to see happen is that we have a nice little profit built in here and so much time between now and June expiration that Bank of America turns around and goes back down below 15, which is our short strike, and we start to lose money on this thing. So at least at this point, we've seen just kind of a sideways action, don't really know what's going to happen, and just figured it was best to close out the trade and move on. Today for opening orders, our new open order is a vertical put spread, kind of trying to use this position here to kind of replace some of the trades that are profitable and rolling off. So still trying to be a little bit more positive in where we think the market might go. But we sold a vertical put spread in CRM, which is Salesforce. That's the ticker, CRM, for July. Now, again, a lot of people have emailed me, new people that have joined over the weekend, which we had a ton of new people. And they emailed me about the July 14. No, the 14 does not mean the number of contracts that we're trading. The July 14 means we're trading the July monthly options and 14 for 2014. So just like down below, the June options are June 14. Those are the June monthly contracts for 2014. Now for CRM, what we did is we sold the 50-45, so a $5 wide spread, sold two of those credit put spreads for $1.06. So that actually moves our break-even point down to around 49. So that's really the level that we're going to be looking at. And of course, we want CRM to go higher as we get towards July expiration. So you can notice that CRM has had a really long drought, right, heading all the way into the end of April and May, but since then has started to kind of turn the corner. We have higher lows and higher highs starting to be made on this stock. So as it starts to continue higher, we have some higher lows and some higher highs, which means that at least at some point we could see a nice little rally off of the bottom here. Now, even during all of this, we have implied volatility that still remains in the 60th percentile. So you can see this is one of those few stocks that are still out there that have really high implied volatility. So with our strikes at 50 and 45 and our break even at 49, that kind of puts our line in the sand right around here. So it does give us a little bit of room to be right in the movement of the stock, and it also gives us a little bit of room to be wrong in where we think that CRM might be going in the next couple months here. Okay, so let's talk about Netflix. So Netflix is a stock that we had originally intended that we think that Netflix would go down as we head towards June expiration, and we had traded the June July 370 calendar, so the 370 put calendar, trading all of the June options or trading all around the 370 strike. Well, obviously Netflix has continued to defy gravity and continued to move higher, which is fine, but at least at this point we're getting closer to June expiration, and the front month option, which was our June 370 put, has now started to make money because as it goes away from that, or as Netflix goes away from that short put, we're starting to make money on that option. So what we did today is we basically created a vertical credit spread to get out of our June 370s, buy those back, and resell the 395s. Now, by doing all of that, we took in a nice credit of $380. So this helps reduce the original cost of the trade, which I believe was over $600 or so, down to around $270. So we've drastically cut the cost of our trade in half by just rolling up this June, or by rolling up basically our 370 puts to 395. So that's basically that vertical, just replacing the 370 with the 395 for June. So when we actually go in here and take a look at where Netflix is trading right now, you can see that the stock just continues to move higher and higher and higher. And at some point it is going to come back down. But at least right now, we're still focused around 370, which it can still hit between now and expiration. But if the stock does continue to go higher, we obviously don't want to take that loss on that side of the trade, right? Because our original calendar was kind of balanced and kind of had that pyramid shape right around 370. So if we go to the Analyze tab now, we can take a look at where the stock is currently trading and where our profit and loss line is in relation to that. Okay, so here's a chart of what our position looks like now. It's kind of this funky calendar looking thing because it's not an even calendar. An even calendar looks more like this, right? It's more of a regular calendar shape, very symmetrical on each side. But now that we have kind of an uneven calendar, basically a diagonal almost, in Netflix, we have this 395 put and this long July, not June, July 370 put. So that reduces the risk by rolling up that credit, or rolling up our put side to the 395. It reduces this top side credit and this profit loss line so that we have much smaller risk to the top side, and that kind of reduces our overall cost. Now we increased our risk just a little bit to the downside because we have now another position even closer to the market. But at least at this point, with Netflix trading around 420, we still have plenty of room between ourselves and the market. Even as Netflix goes down, we actually make more money. So we still want Netflix to continue lower. And that's obviously the ideal situation, is that it continues lower and kind of trades somewhere around 390, 395 or so. But in the case that it does continue higher, we're actually going to do okay, and we've reduced our risk on this trade on our overall loss if Netflix continues higher. So really that's the hedge today. It's actually a pretty simple hedge. We're just kind of replacing the 370 put for June with the 395 put, kind of rolling that put closer to the market and taking in more credit. Now, as always, I hope you guys really enjoy these videos. Please let me know if you have any comments or questions. Ask them right below this video in the membership area of our website. I'll get back to all of those tonight or tomorrow before the open, and happy trading.